In April of 2020, the Federal Reserve created $5 trillion in just 8 weeks. In 2021, Congress mailed stimulus checks to people who never lost their jobs. In 2022, Russia was cut off from the SWIFT payment system for invading Ukraine. In 2023, China and Brazil began settling oil trades in yuan. In 2024, central banks bought more gold than in any year since 1950. And right now, in early 2026, the yield on the 10-year Treasury is higher than it was at the peak of the inflation crisis. So here's the question: when does a recession stop being the thing we should be worried about? Look, I've been managing my own money for over a decade. I've got several $100,000 spread across index funds, real estate, and yes, some gold. I'm not here to sell you panic. I'm not here to pitch a course on how to survive the collapse. I'm here because I spent the last 3 months reading the actual documents. SEC filings from Bridgewater Associates, IMF working papers on reserve currency transitions, and Bank for International Settlements reports that nobody reads because they're 800 pages of central bank speak. And here's what I found. We're not heading into a recession. We're heading into something structurally different, a change in the rules of money itself. And your 401k was built for a game that's ending. So in the next 15 minutes, I'm going to walk you through how monetary systems actually work, using a metaphor we can keep coming back to. Think of the global financial system like a massive commercial lease. After World War II, the world signed a lease with the United States. The terms were simple. The US dollar would be the global reserve currency. Oil, goods, and debt would be priced in dollars. In exchange, the U.S. would maintain a stable currency, keep inflation low, and provide military security to keep trade routes open. That lease has been running for 80 years. But here's the problem with long leases. The landlord starts taking liberties, and the tenants start looking for other apartments. The first liberty the U.S. took was in 1971, when Nixon closed the gold window. That was the moment the dollar stopped being backed by anything except trust. For a while, trust was enough. The U.S. had the largest economy, the strongest military, and everyone needed dollars to buy oil. But trust is a psychological asset, and psychological assets decay when you abuse them. So let's talk about abuse. The U.S. national debt is now $36 trillion, roughly 120% of GDP. To put that in perspective, if you earned $60,000 a year but carried $72,000 in credit card debt, your debt-to-income ratio would match the U.S. government's. Now, you might say we've had high debt before, and that's true. After World War II, debt to GDP peaked at 106%. But here's what was different. Back then, the U.S. had a young population, a strong manufacturing base, and it was a net creditor to the world. Today, however, the U.S. has an aging population, outsourced manufacturing, and it borrows money just to pay interest on money it already borrowed. That's not a debt problem, that's a Ponzi scheme. And this is where the psychology gets interesting. When you're running a Ponzi scheme, you have two options. You admit it and restructure, or you keep it alive by finding new buyers. For the last 15 years, the Federal Reserve has been the buyer of last resort. Every time Treasury yields spiked, meaning nobody wanted to lend to the U.S. government, the Fed stepped in and bought money to buy bonds. That's called monetizing the debt. It's also called inflation. But that trick only works if the rest of the world still needs dollars. Which brings us to the second signal of a dying monetary system, what Ray Dalio calls the big cycle of internal order and disorder. When wealth inequality gets extreme, societies fracture. And the data here is wild. In 2024, the top 1% of Americans controlled 32% of all wealth. The bottom 50% held just 2%.
That gap is wider than it was in 1929, right before the Great Depression. Inequality alone doesn't break a system, but it creates political instability, and political instability makes investors nervous about holding long-term government debt. If you think a country might default, see civil unrest, or rewrite the rules, you don't lend it money for 10 years at 3%. So what do you do instead? You buy gold. You buy real assets. You move capital into systems not tied to political instability. And that's exactly what we're seeing. In 2024, central banks bought over 1,000 tons of gold, the second highest year on record. China, Russia, India, Turkey. They're not buying gold because it's shiny. They're buying it because they're quietly exiting the dollar lease. Now, you might be thinking, people have been predicting the death of the dollar for decades. Fair point. But here's what's different this time. The third force in Dalio's framework is external order and disorder, geopolitical conflict. And right now, we're seeing the biggest realignment of global power since the Cold War. Russia invaded Ukraine and got kicked out of SWIFT, the global banking messaging system. That was supposed to cripple them. Instead, Russia began settling trade with China in yuan and rubles. China and Brazil agreed to trade in local currencies. India started buying Russian oil with rupees. Gulf states, who've priced oil in dollars since the 1970s, are openly discussing multi-currency pricing. This isn't theory, this is happening. And here's the kicker. When you weaponize the dollar, you teach the world how to live without it. That's not a conspiracy, that's incentives. If I can lock you out of the financial system because I don't like your foreign policy, you're going to build an alternative. And once that alternative exists, everyone who's worried they might be next starts using it too. It's the same psychology as a bank run. Banks don't fail because they're insolvent. They fail because people think they might be insolvent, so they pull their money, which makes them insolvent. Now let's get concrete. Meet Alex. Alex is 42. He has $350,000 in his 401k, all in a target date fund. He earns $110,000 a year. He contributes 6%. His employer matches 3%. Every retirement calculator says he's on track to retire at 65 with $1.8 million. Sounds great, until you look at the assumptions. Those calculators assume 7% annual returns. They assume 2.5% inflation. And they assume the dollar in 2049 buys roughly what the dollar buys today. If we're entering a monetary transition, all three assumptions break. If inflation averages 5% instead of 2.5%, Alex's $1.8 million only buys what $800,000 buys today. He just lost $1 million of purchasing power, and he won't realize it until it's too late. And it gets worse. If the dollar even partially loses reserve currency status, interest rates have to rise to attract buyers for U.S. debt. Higher rates mean lower stock valuations. The entire S&P 500 is priced on the assumption that the U.S. can borrow cheaply forever. If that assumption breaks, we're not talking about a 10% correction. We're talking about a repricing of everything. Alex's target date fund gets crushed. Bonds lose value when rates rise. That's not opinion, that's math. To be clear, this doesn't happen overnight. Monetary transitions take years, sometimes decades. But slow disasters are the most dangerous ones, because people don't change behavior until it's too late. It's climate change psychology. It's smoking psychology. You know it's bad, but it's not bad today, so you do nothing. And then one day it's bad, and you can't undo 20 years of compounding mistakes. So what can the U.S. do? Option 1, fix the fundamentals. Cut spending, raise taxes, restore trust. That's not happening politically. Option 2, change the rules. Maybe the U.S. issues bonds partially backed by gold, not a full gold standard, but a trust restoration mechanism. But with 8,000 tons of gold worth about $600 billion against $36 trillion in debt, gold would need to be revalued above $4,000 an ounce just to cover 10%, and that assumes the gold is actually there. Or maybe the U.S. pivots to a digital reserve system. Bitcoin is already being accumulated by nation-states. El Salvador adopted it. The U.S. reportedly holds over 200,000 Bitcoin seized from criminals. But every solution requires coordination. And unlike 1945, the world now has options. China, Europe, India, they don't have to renew the lease. Which brings us back to the point. What's coming isn't just a recession. A recession is a reset within a stable system. What's coming is a reset of the system itself.